Let's get more on the dollar's impact in the markets with Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, good to see you.
Hey, Mel, great to see you.
Do you think the dollar strength is going to be a factor in Q3, Q4?
You know, I think today was all about a macro counter trend trade, and you guys have talked about it pretty well on the opening. The dollar, at the same time, stocks bounced, the dollar weakened, commodities got hit, oil got hit, and bond yields, long bond yields started coming down. So it just looked to me like everything got a little bit too extreme, and it was a little bit of a reversal of that, Mel.
So you said you're in the notes at least about a Fed pivot, that this could happen. And I'm wondering, we were just discussing what that means now. I feel like it's lost all meaning. What, in your view, is a Fed pivot?
It's a soft pivot. It's a maybe pivot. What kind of pivot? No, I think that you need an action. So, okay, let's put aside the Fed. I'll talk about that in a second. But I can't. One of the reasons that I didn't chase that momentum move off of the low into the August peak, even with such great momentum and tape data, was the fact that I couldn't find a major market low, Mel, that didn't have the 2-year note yield already trending lower from peak and the Fed clearly stating that they were pivoting. And I think that's really what it looks about. I don't think maybe if you do 50 versus 75, you can get a counter trend rally like we did with the August rally, the summer rally. But ultimately, you really have to have, and here's the reason. There's a fundamental reason, Mel, that's really important. The reason that when the Fed pivots, it allows investors to look through the coming economic weakness because it has a stimulative effect when you look to 6 months to 12 months down the road.
Tony, so the Fed pivoting is certainly going to be on most people's checklists for what are the things that make you turn bullish. But talk about things that are a little bit more here and now, or some things that might be a little bit more granular, whether it's market breadth, whether it's some different parts of either the inflation chain, not necessarily even headline inflation. What do you need to see? And again, for someone who's been very tactical in here, talk about that in terms of timelines.
Sure, Timmy, thanks. So what caused us to write a note about a bounce yesterday was that yesterday was the 7th consecutive day where you had more than 90% of the S&P components trading below their 10-day moving average. When I go back and look at the last 32 years since 1990, I've only seen that twice. Once was in the swoon of 2011 and August of 2011, and the other was in the swoon of October of 2008. Neither one of those proved to be the low, but it was extreme. It caused what we saw today, a tinder that was ready for an oversold bounce. So there's that on the tactical side. And on the fundamental side, I think we're looking at the wrong thing. Inflation already has peaked. The CPI came down. The core PCEs come down 3 or 4 months in a row. It's the unemployment rate. I think what causes the ultimate Fed pivot is when you have the inflation data coming in like it is and everybody's talking about. But what if you get a spike of 0.5% in the unemployment rate over the coming few months? And that's exactly what is happening. I think I said on the last time on the show, where the NFIB hiring plans index, which is small business hiring plans, has deteriorated to a degree that suggests a pretty meaningful up move in the unemployment rate by year end.
Tony, $220 worth of earnings is your forecast. What's the right multiple? 18 multiple, market multiple, it gets us exactly where we are today. 16 multiple, I can do that math. That's 440 points in the S&P lower. What are your thoughts on that?
Guy, you know, I don't have a target. I think it's kind of one of those made for TV things where we all of a sudden come out with a target, it beats our target, so we raise our target. So let's look at the history. And the history shows that when the core PCE trades between 3 and 4%, which is where I think most people and myself forecasted for 2023, your average multiple is about 16.5 times. So if you want to, it always goes by core inflation because that's what ultimately drives the bond market. When you look at it above 4%, it's about 13.5. And when it's between 1 and 3%, it's 19. So it really depends on core inflation. The current consensus call that I think is right means should be somewhere between 16 and 17, Guy.
Tony, great to see you. Thank you.
Awesome to see you. Thanks, Mel.
Tony Dwyer. All right, so Tony is sector neutral. Basically, he doesn't recommend any S&P sectors right now. Dan, if we see this sort of mini rally back to that downtrend, which sectors lead us there?
Yeah, well, I think it's tech. I think it's tech that's been beaten up here. You know, there have been some groups that are deemed defensive that have acted pretty well here. Obviously, there was a lot of crowding in energy stocks, so I continue to think that they would be weak. I understand that the fundamentals are probably a lot better for these companies going forward, and some of the geopolitical things will keep the pedal on the metal. I want to keep an eye on financials here because Tim brought this up yesterday. I think the idea of some sort of defaults that could start in Europe, given the situation over there. We know that the credit situation or the housing situation over in China is really bad. Let's see how the banks can rally here. That's the one I'm going to keep a very close eye on.
I'm constructive after these next few months. I'm constructive going into year end after the midterm elections. I'm not constructive now because the last person to say they're going to pivot is Powell. I think you have to call this a pace pivot versus an actual pivot.
A what pivot?
A pace pivot.
A pace
we just
pivot?
need that pace of rate increases to slow down. So if we see that, that's not the real pivot, but that's the pivot we're going to get now.
See, I always assume that when I hear a term that I don't understand, it's some like sports metaphor, or it's like something
look,
about
on this desk, we are coining terms right and
pace
left.
pivot.
But the pace pivot makes sense to me. And back to the multiple that Guy brought up with Tony and Tony's forward. Over the last 15 years, the S&P forward PE multiple has been 15.8. It's 17 now. Should we be trading at a premium forward multiple at a time when there's a lot of things that I think have yet to play out? So it just tells you where, if we get back to even normalized that pace pivot.
Thank you.
One more P, Guy, we could get some really good alliteration.
Yeah, no, without
PP
question.
is not bad either.
I'm tapped. No, it's powerful. It's powerful, isn't it?
It's a powerful pace pivot. There's your other P.
You know, in races back in the day, in longer races, they would put somebody in to have the pace.
Right.
And that person would then fall off the pace later in the race. That's one of those more you know that NBC is so fond of. We should have the graphics ready to fire, but we don't, unfortunately.
The rainbow.
Yeah, the rainbow, more you know.
Imagine it.